Howdy, everybody. Welcome to Liberty Call. Today is Monday, December 11th, 2023. Hope everybody's having a good day out there and hope you had a good weekend. It was a bit snowy here in Colorado. There's a nice little path of asphalt that you can see through out to the street, and it's just white everywhere else. So didn't get too much. I mean, it wasn't heavy, but enough to cover the ground. So at least on the north side of my property. On the back side, where the sun gets it, it's all melting away. Anyways, if it is your first time watching Liberty Call, I'm glad you're here. If you could do me a favor, give me some thumbs up, like, share, subscribes, follows, and press that notification bell. And let's go ahead and get into today's news. All right, starting out with the markets. Dow Jones was up 0.43%, 157 points, closed at 36,404. S&P 500 was up 0.39%, closed at 4622. NASDAQ up 0.2%, closed at 14,432. The VIX was up 2.19% today. It's at 1262, which again is a little odd to see the VIX going up at the same time that the S&P 500 going up. Canada down 0.06, so basically flat. Brazil down 0.13, and Mexico is up 0.1%. In Europe, Germany was up 0.21%. The UK down 0.13%. France up 1/3. The Netherlands up 0.59%. Spain down 0.25%. Italy up 0.07%. Switzerland up 0.53%. And Portugal down 0.9%. Russian exchanges both in the red today. The MOEX down 1 3/4%. RTSI down 0.6%. And the overnights, the Nikkei in Japan was up 1.56%. Australia up 0.06%. New Zealand down 0.51%. In China, the Shanghai was up 0.74%. The Shenzhen Component up 0.82%. China A50 up 0.13%. DJ Shanghai up 0.84%. The Hang Seng down 0.84%, and the Taiwan weighted was up 0.2% for the day. So yeah, kind of most things are pretty good. I mean, there were a few down markets here and there, but nothing too terrible. So we shall see where this takes us. All righty, let's go ahead and get over to the weekly economic update for today. A late week, 2-day rally left stocks higher, adding to November's gains as the last month of trading for 2023 began. The Dow Jones Industrial Average was flat, up 0.01%. S&P 500 gained 0.21%. NASDAQ was up 0.69% for the week, and overseas markets were up by 0.37%. So again, kind of a flat week across the board. Stocks extend gains. The relationship between the bond and stock markets, which pushed stocks higher in November, i.e. falling bond yields and rising stock prices, disappeared last week, with stocks falling in the first 3 days of the week despite declining yields. Yields dropped following a weak job openings report, the ADP employment update, and a substantial productivity revision. On Thursday, investor enthusiasm returned with force on artificial intelligence-related news. One AI chip manufacturer announced a new AI chip, followed by a mega-cap tech company unveiling an enhanced version of its AI model for business use. Stocks continued their climb on Friday, despite rising yields, as investors viewed a stronger-than-expected employment report as increasing the potential for a soft landing. So I think people are kind of coming to grips that interest rates aren't going down anytime soon. So now the next hope is, hey, please let this plane not crash into the ocean. So, all right, next up, productivity surges. Higher productivity may be the most effective and preferred way to reduce inflation. Last week's revised third quarter productivity report saw an upward revision of the annualized productivity growth from the initial report of 4.7% to 5.2%. This was welcome news on the inflation front and an encouraging development for future corporate profits. The 5.2% jump in productivity represented the fastest pace since the third quarter of 2020. The report also showed unit labor costs falling at 1.2% annualized pace, reflecting a cooling wage growth inflationary pressures. Productivity has increased for 2 straight quarters, potentially allowing the Fed to ease its restrictive monetary policy. Economic data this week. Tuesday, we have the Consumer Price Index. Wednesday, we have the Producer Price Index and the FOMC announcement. Thursday, we have retail sales and jobless claims. And Friday, industrial production and the Purchasing Managers Index Composite Flash. Just a few companies reporting earnings this week. Wednesday is Adobe. Thursday is Costco Wholesale. And Friday is Lennar. All right. So there's the weekly update. Exciting stuff. I know, folks, you are on the edge of your seat. I can just see you out there just like, what's he going to say next? All right. Let's get to today's market recap. Stocks climb as investors eye fresh inflation data ahead of the Fed meeting. And the Fed meeting is going on the 12th and 13th, which is tomorrow and Wednesday, which is why they have an FOMC announcement on Wednesday. That makes sense. All right. U.S. stocks experienced gains as investors continued their bullish stance on risk assets, anticipating fresh inflation data and the Federal Reserve's upcoming policy meeting. Both the S&P 500 and NASDAQ reached their highest closing levels since early 2022 in the previous session, with the Dow marking its sixth consecutive weekly gain, the longest positive streak since 2019. Investors are closely watching the FOMC meeting for clues on interest rate cuts. The FOMC is expected to maintain rates between 5.25% and 5.5%. Focus will be on the Fed's economic projections, inflation outlook, and expectations for rate cuts in the coming year. Market expectations for a quarter-point rate decrease in May have risen to nearly 50%, influenced by recent jobs data and a slowdown in underlying price gains. So we shall see. I mean, we'll go through the the meeting minutes next month. They usually come out a month later, so I'm sure they'll talk about what's going on right now and all the details of all the economic crap that they sift through, and then say, we're just going to leave things alone right now, or we're going to raise rates. But like I said, these people again. You can go back to the articles I covered a year and a half ago, and they were already talking about lowering rates. And it was like, we haven't even got them above 2% yet, and you're already talking about this. All right. In corporate news, U.S. health insurer Cigna decided to end talks about acquiring peer company Humana, citing disagreements on price, regulatory concerns, and a decline in share prices. Concurrently, Cigna announced plans for an additional $10 billion in share buybacks. Meanwhile, Macy's surged over 21% after reporting, reportedly receiving a $5.8 billion buyout from Ark House Management and Brigade Capital Management, representing a premium of approximately 21%. Oh, well, that would be why it went up 21%. Tech stocks lagged on the day, with Microsoft and Alphabet experiencing declines, but semiconductor stocks, including Global Foundries, Applied Materials, and Broadcom, limited losses. Broadcom gained over 9% after Citi resumed coverage with a buy rating. In the energy sector, Occidental Petroleum agreed to acquire shale driller Crown Rock for $12 billion, signaling continued consolidation in the industry. Other energy companies, such as Hess Corporation and Baker Hughes, posted gains despite sluggish oil prices ahead of the Federal Reserve meeting. So that's today's news. Let's go to our last article of the day. It comes from our friends over at First Trust, Mr. Brian Westbury, their chief economist. This week's article is titled, "What Should the Fed Do? How About Nothing?" I agree with that most of the time. All right. Mr. Westbury argues that for the first time in roughly 15 years, interest rates in the United States are about right, hovering around the natural rate. Various economic models, such as the Taylor rule and a model based on nominal GDP growth, suggest that rates should be higher. However, Westbury contends that these models may be distorted by the impact of COVID. A simpler approach proposed by Westbury is to assume that interest rates should be inflation plus, using an average of the Cleveland median CPI and overall total CPI. Westbury calculates an inflation rate of 4.2%, suggesting that rates should be around 5.2%, which is approximately where the federal funds rate stands today. Mr. Westbury highlights a significant change, noting that between 2008 and the present, the Federal Reserve kept the funds rate below inflation about 82 or 83% of the time, creating various issues such as mark-to-market losses for banks and challenges for government-funded projects. Westbury emphasizes that artificially holding rates down done by the Fed may provide a temporary appearance of stability, but it is unsustainable, which we're finding out right now. While Westbury acknowledges that the Fed rapidly increasing the M2 measure of money in 2020 and 2021, leading to anticipated inflation, he notes that the M2 measure is now contracting, With money contracting and interest rates near normal, Westbury suggests it is appropriate for the Fed to pause, especially as tighter money seems to be helping bring down post-COVID inflation. However, Westbury warns against claiming victory and returning to an environment of artificially low rates, which could risk repeating mistakes of the past. He expresses concern about the potential of a recession in 2024 and the pressure of the Fed to cut rates and restart quantitative easing. That's the money printing, emphasizing the importance of ensuring that inflation continues to fall and reduce to the neutral interest rate. Westbury also discusses a shift in thinking among bank regulators, Fed members, and Treasury officials regarding mark-to-market accounting. He argues that policies implemented since 2008, including quantitative easing and TARP, intended to make the financial system safer, have not succeeded, with banks now facing substantial estimated losses due to Fed policies. Westbury questions the consistency of those who previously advocated for mark-to-market accounting and suggests that managing the economic challenges ahead may not be as straightforward as some believe. He's probably right. He's a very smart guy, and I really trust his judgment on most things. So anyways, all right. Well, that's everything we have for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.